financial markets in turmoil.
What are the root causes of the financial crisis?
The dollar losing value.
Heading for its biggest loss in nearly 3 decades.
Will Social Security even be there?
I don't know.
Buy or rent?
That's a very good question.
Interest rates.
I'm not so sure.
Where do you put your money?
I don't know.
Welcome to the show that answers your questions. This is Follow the Money Weekly with your host, economist, and best-selling author. Here's Jerry Robinson.
Friends, welcome to this week's program. So glad that you're joining us. This is Follow the Money Weekly Radio. My name is Jerry Robinson. I am your host.
And I'm Jennifer Robinson, your co-host.
So glad to have you here, Jennifer. We're going to dive right in and talk all about just some pretty bad negative economic news. Unfortunately, as we look around, we see bright spots and we see not so bright spots. And one of the very first things I want to call your attention to this week is the State of the Union, that the address that we saw from President Barack Obama. Now, I'm not going to play you all the different clips that we have from it because we have other things we want to get into, but I do want to tell you that as I sat and watched the State of the Union, and yes, I did watch the whole thing, and what was most disturbing to me out of the entire speech was the fact that there seemed to be no cognizance of any kind of major economic problems on the horizon. As I listened to the president speak about the economy, as I listened to him speak about what he wants to do to get more people back to work here in the United States, it was almost as if you were listening to a man who had no clue that we had fires burning all over the world, that we had a dollar that was on the very edge of the cliff as far as its continued reserve currency status on the globe, and also the fact that we are completely bankrupt. I mean, all he talked about was some of the new spending that he wanted to do, and this blew my mind. In fact, it was very disheartening to me because it seems as if as the car careens ever closer to the brick wall at breakneck speed, there is no one putting on the brakes. Not the Republicans, not the Democrats. Neither party is putting on the brakes. Neither party is dealing with this entitlement crisis. And I know that many of you don't like that word entitlement. I don't like that word entitlement. You know, people who paid into Social Security, you pay FICA taxes. When you get your Social Security check, you're getting your money back, is how I view it. So you're not getting something from the government for nothing. You paid into that. And the same thing goes for Medicare. I mean, we pay for these things. So I know when we say entitlements, some people cringe and say they're not entitlements. And you're technically correct, but nevertheless, that's the term for them.
Jerry, to me, it seems like the State of the Union address, and really anytime we hear the president speak and we hear many of the different congressmen and senators speak on different topics, it's like going to the doctor for 10 years in a row, going to the doctor every single month because of some back pain maybe, and the doctor continues just to give you some pain pills. He just gives you some pain pills and says, okay, come back and see me next month, and never attempts to determine what the cause of the back pain is.
Yeah, they're striking not at the root, but striking at the branches. And that's what they've been doing over and over and over again. And that's why you can't support either party. I mean, both parties are swinging their axe at the branches trying to cut down the tree. And that sure does take a long time to cut down a tree when you don't lay the axe to the root. I mean, that's how you cut a tree down. Never before in America's history has the writing been more clearly visible on the wall. Remember this Bible story, for those of you who've read the book of Daniel, my favorite book, and it talks about the writing on the wall in the kingdom of Babylon. And that phrase and that story, you know, comes down even to today, this idea that the writing is on the wall. The writing is on America's wall. I mean, it's right there. And in fact, we have a brand new article we put up on our website talking about some of the signs of the writing being on the wall. I mean, these statistics you've heard me talk about before, but I want to lay them out real briefly again, because they're also in the article. You can read them there. Today, and Jennifer, feel free to comment on these. I mean, I think these are staggering. Today, 40% of Americans admit to having less than $500 in liquid savings. 4 out of 10 people admit to having less than $500 in liquid savings.
That's a scary, scary place to be.
What does that feel like? What does it feel? I mean, we know what it feels like, but at the same time, what does it feel like right now in the middle of all of this crisis, when all this stuff is going down and you see the terrible news? What does it feel like not to have 5 Benjamins to rub together because of whatever reason, whether you can't save because, you have too much debt, or you just don't want to save because you'd rather spend it? I mean, who knows? But that's an outrageous number. Now, the next one that we want to point out is 25% of American workers in the age bracket of 46 to 64 report not having a single dime in retirement savings. That's 1 out of 4 people who are almost baby boomers, and then some baby boomers. And 26% of that same demographic admit they have no savings of any kind whatsoever. They don't have any savings. The next one, 60% of American workers report that the total value of their savings and investments is less than $25,000. So that's 6 out of 10. I mean, you know how quickly you could burn through $25,000 when you get to retirement? I mean, that's not even a full year for most people. According to a new Pew Research study, 1 out of every 7 adults in the United States is financially supporting their kids and their parents at the same time. Now, this is what they call the sandwich generation. And many people today are, opting to help their parents and financially support their parents. And I really believe that's admirable.
Yeah, I totally agree with that concept and with that model. But I believe most of the people who are being kind of forced into that perhaps were not financially prepared to do so.
Exactly. And many times back in the olden days, to use that phrase, the idea was, yes, we take care of our parents. We are assets, not liabilities to our parents. They take care of us in our younger years, and whenever they grow old, we take care of them. And that has traditionally been how things have been in history. This new era that we're in, we saw a move away from that as people were very autonomous. They were very individualistic. And the idea of retirement didn't include, living at your son's house. I mean, the idea of retirement involved traveling in an RV and playing on the golf course and living in a nice home. And really,
and of course, that's just breaking down something fierce right now because of the 3 or 4 statistics you just mentioned right before that.
Yeah. And so there's a tremendous shift going on. And you know what? I don't think necessarily that this particular trend is that negative, because I do like to see families closer together and supporting each other and helping each other. I think we've got away from that. It's sad that we are somewhat being forced into that situation, but I do like the fact that it is occurring. But there's another statistic that's been put out. This is very shocking, that many of retirees and many elderly are ending up in homeless shelters because they can no longer afford either their rent or their home payment, and the son and daughter necessarily don't want to take care of mom or dad. And so they are being basically put in these homeless shelters. And I read some horror stories. In fact, we'll put a link up on the website today for you to read about this. But, I mean, just a shocking number of stories of people just dropping off their elderly parents at homeless shelters, just dropping them off. One lady rolled up to a homeless shelter with a broken wheelchair, and she was wearing a hospital gown, just basically got dumped off. These stories are going to continue to pile up. We're going to continue to see more of this because people can't afford to take care of themselves and to take care of, their loved ones as well. And this is a very sad thing. But here, this is the fruit of what a lack of savings produces. This is why we pound the drum so hard for people to save money and to invest wisely, because you don't want to end up at the end of life, taking medications, then you live to be 110, but you don't have any money. That's a scary place to be.
It sure is. And one of the things, not to get off on a tangent too much in the middle of all this, but one of the things that Jerry and I are really interested in, and especially if you're younger, maybe, younger than 40 or 50, and you have your parents around, getting some land and trying to get to where you can live off the land, and your parents may live on one section of the land and your family lives on another section of the land. And it's kind of like living together and bartering services, helping each other out.
Yeah, creating a community. And I think we're seeing more of a move back towards that. I mean, that's not uncommon in rural areas. I mean, you go out and you see, okay, dad lives here, brother lives on this part of the land, and so lives on this part of the land. They're all related. But we're seeing a move back towards that, I really believe. Another statistic, nearly 50% of Americans, that's 132.1 million Americans, admit that they do not have enough liquid savings to cover their most basic expenses for 3 months in the event of a financial emergency. 132 million Americans, almost 50% of Americans, could not survive more than 3 months without their paycheck. I mean, that is a tremendously telling statistic that is, very discouraging.
Again, I understand how stress levels are so incredibly high in this nation, because not only health situations. I mean, not only are you probably fighting traffic every morning and every evening, going to work and from work, and all the stress that comes with just everyday life, but then to know that you may not be able to cover your basic expenses if you were to lose that job. What a stressful place to be in. And we don't want that for anybody listening to this show.
That paycheck to paycheck mentality just becomes, I would imagine it's extremely stressful, and it hurts your health in the long run. Another statistic, according to the November 2012 latest figures put out by the government, over 47 million Americans now receive food stamps. That is 1 out of every 6 Americans receive food stamps. Put that in perspective, 47 million people live in the country of Spain. So the number of people living in America who are receiving food stamps, you put all those people together, they make up a larger number than the entire population of Spain. Now, the number of food stamp recipients is going up every single day by 11,000 plus. 11,000 plus. Ever since Mr. Barack Obama entered office, we have been seeing those numbers. Were they growing before he entered office? Yes. Were they growing after he entered office? Yes. Will they continue growing after he leaves office? Yes. Until we have some sort of fiscal and monetary sanity restored to our capital and restored to the basic institutions of our government, we're going to continue to see out of control dependency upon the federal government. Now, another thing that we're seeing also is the federal disability income. Many people are dependent upon, and I want you to pay real close attention to me if you're receiving disability income or you know someone who is, because this is a very important point I'm going to make to you. As of January 2013, the Social Security Administration reported that about 8.8 million Americans currently receive a disability income payment of some form from the government. Now, that number has been increasing every single month for the last 192 months. The number of Americans enrolled in the disability program has continued to increase for the last 192 months.
What's that, like the last 15, 16 years?
The last time that it decreased was in the month of January 1997. That was the last time that disability claims actually decreased. So we are experiencing a massive upward trajectory. It's firmly in place. Now, the latest assessment of the Social Security program by the Congressional Budget Office reported that that disability trust fund, where the money comes from to make those payments, will be completely bankrupt or depleted by the first quarter of 2016, which means there will be no longer any money in that pool to send to people who are currently receiving disability income. Now, is the government going to stop sending disability payments? Well, that's not likely at all. But what will they do? They will simply go to move to another trust fund and rate it. Now, according to current law, they're not allowed to do that. They can't take money out of another trust fund and use it for this trust fund.
So we'll have another big cliff that we're going to fall off of come 2016, and it'll be a big to-do.
And the price
finally pass it at the last minute, right, Jerry?
Exactly. You're learning how they work in Washington. I mean, that's exactly how they do it. And you know what's so interesting about this is that the Social Security Trust Fund itself is also dwindling very rapidly. When I wrote my book, Bankruptcy of Our Nation, and you've probably heard me say this before, when I was researching all the material back in 2008 for the book, we had called one of the chapters the 2040 crisis, because in 2040, the CBO, the Congressional Budget Office, had forecast that the Social Security Trust Fund would be completely depleted or bankrupt. And so we called that the 2040 crisis. Well, when I researched the book again in 2012 for the revised and updated edition, I was surprised to see that that number had dropped down to 2036. It was no longer 2040, but now 2036 would be the year that the Social Security Trust Fund would no longer have enough money in it to make the payments. It would be going into the red. Now, the latest projections from the CBO that were just put out in February of this year show that that total bankruptcy date has been moved back now to 2031. So this just continues to go down. The year that Social Security is going to be depleted, I expect to be sometime in the 2020s, maybe even as early as 2020. They keep lowering it, and it seems like every couple of years it drops back about 5 or 6 years. So it's just a matter of time before we just run smack dab into it. And, of course, they're going to have to pull money out of the trust fund with Social Security to pay for the disability income. So, I mean, it's a total train wreck. And here's the point. The State of the Union didn't say anything about that. When I watched that State of the Union, friends, I thought to myself, how in the world are they not bringing up the most obvious problems with our economy? It's as if they don't care or that they know that they can do nothing about it. I don't know what the motivation is. I don't know why they aren't saying something about it. I can't read their minds. I just know that it's unbelievable that they are not addressing these problems and that the people are going to pay the ultimate price because they actually believe that these programs are going to last. You know, many people do. They depend upon them. So we have a real retirement crisis on our hands here in the United States. Within 1 decade, I really do predict that our country is going to look very, very different from what it looks like today. And within 2 decades, I predict that we're going to be seeing a very completely different picture of what retirement even means, a definition of retirement. The idea of retiring at the age of 65 and getting the Timex, Rolex if you're lucky, and sailing off with your golden parachute into the sunset is just not reality anymore. So many people today know that they're going to have to continue working well beyond the age of 65. And friends, that's one of the reasons we put this program together, and one of the reasons why we continue to do the work that we do is we feel called to help you in this time that we see coming. Remember the story in the Bible of Joseph? And Joseph sees the famine coming, and he is moved into Egypt, and he's allowed to really kind of rise in the ranks, and he's able to help the people of Israel. It's the same way that in many ways that Jennifer and I view our organization, is that in many ways it's kind of a Joseph organization. It's kind of helping people prepare for what's coming. This does not end well. History tells us this. The currency, the United States dollar, I mean, we haven't even talked about that. But there's news on the petrodollar this week. And I'll talk about that for a minute now. Tom Cloud's going to come on. I don't think he's going to talk about the petrodollar too much, but we'll talk about that in just a minute. But there's been news on the petrodollar system. The amount of money that is held in dollars by foreign reserves by central banks is going down. The amount of total money supply with U.S. dollars around the globe is being trumped by the yen and by the euro and the yuan even. And so we're seeing, a massive move away from the dollar, and it just continues over and over again. Every single quarter we're seeing new evidence that it really is moving that direction.
Right, and like you say often is Americans specialize in consumption, and our number one export is the U.S. dollar. And so just like other countries like Japan exports automobiles, it would hurt their economy if other countries did not want to buy those automobiles from Japan. It hurts our economy when our number one export, the dollar, people reduce their holdings of that dollar. And so I think what you were saying is very important. I mean, you may listen to this and say, well, countries are reducing their holdings of the dollar and blah, blah, blah. Sounds like it doesn't apply to me. But it really does, because we all hold dollars in our pockets. And when other countries don't want to hold that dollar as much anymore, that means bad things for our purchasing power and for the future of the dollar.
It definitely does. And the American currency, I mean, the U.S. dollar, it by no means has it lost its global reserve status. It still is the king of currencies today. It constitutes about $3.7 trillion of the approximately $6 trillion in foreign exchange holdings by the world's central banks. So it's about 62%. Roughly of all of the central banks, they hold their money in dollars. The Japanese yen, the Swiss franc, and the Chinese yuan are actually increasing their market share of that, while the U.S. continues to go down each and every year as far as the holdings. And as far as the dollar as a percentage of the total global money supply, the total has plunged from nearly 90%, according to a report put out by CNBC, nearly 90% in 1952, down to 15% now. The Chinese yuan, the Japanese yen, the euro all have a greater share than the U.S. dollar. So why is this the case? It's because America has a fiscal credibility problem and a monetary credibility problem. People are beginning to distrust the U.S. dollar. They have for a long time, but they're beginning to publicly distrust the U.S. dollar. And why that's important to you, as Jennifer had pointed out, is that whenever countries finally move away from the dollar, we lose our permission slip to print money. That's how we're paying our bills, friends. That's how we're paying all of our debts. That's how we're paying the interest on the national debt. That's how we're paying for the wars. That's how we're paying for many of the entitlement programs. That's how we're paying for many of the veteran benefits. We are borrowing money as we print it from the Federal Reserve. Now, we can only do that as long as countries are willing to allow us to. They have to be willing to buy our debt as we print money. And here's the point. Whenever they are no longer willing to prop up the dollar, these other countries, and willing to hold it, willing to keep it out of our own economy, then we're going to have to pay our own debt, and we won't be able to print the money to do it. Where does that money come from? It comes from where? It comes from the $19.4 trillion that are sitting in government-controlled retirement accounts, like IRAs and 401ks. Yes, they will come after that money. Where else does it come from? It comes from higher taxes upon the middle class. It comes from higher taxes upon the wealthy. It'll come from all different kinds of higher tax rates. And finally, it'll also come in the form of austerity. They will simply remove many of the benefits that you're currently receiving. And you don't want to wake up 5 or 6 years from now and say, oops, I better start saving. We want you to begin to do that now. We want you to be ahead of the game, seeing all of this coming. The writing is really on the wall. So it's very important for people to be preparing for this. One thing I haven't even brought up, Jennifer, and I tell you, this is really concerning. And I don't want to slam those who work in colleges or universities, because I know that there are many good people there. We both attended university. We both believe in higher education, by all means. I believe that if you truly want to go and make something of yourself and you really want to go to college, you should. And there's plenty of reasons to do that. But when we take a look at the college and student loan debt these many students are ending up with, we're talking about some massive, massive debt. Based upon current projections, the cost of a 4-year degree from a state college will cost a whopping $120,000 by the year 2015. Let me repeat that.
That's unbelievable.
Based upon current projections, the cost of a 4-year degree from a state college, not a private college, a state college, will cost a whopping $120,000 on average by the year 2015. Now, that is a problem. That's a big, big problem. And you know, back in 1992, they changed the law which allowed students to actually sign a piece of paper, and simply for their signature, they could borrow, tens of thousands of dollars, And so that changed. I mean, before 1992, parents had to co-sign and all of this, and you couldn't borrow $50,000 as an 18-year-old kid. I mean, there's no way they're going to loan you that kind of money. But not anymore. The government stepped in and said, well, everybody needs an education, just like they said there needs to be a chicken in every pot back in the 1940s, or they said everybody needs to own a home. This dream of home ownership, and they made housing so affordable and made qualifying for a mortgage so easy because the government has these distorted policies. And so they are making it very easy now for young people to borrow tens of thousands and sometimes six figures in student loans. And in case you haven't noticed, and I just learned this recently, and I was surprised to learn this, in 2006, they changed the law that on the student loans, they're actually adjustable rate. They're variable rate. The government's not dumb. They're not going to let you lock in, $50,000 at 2%, for the next 30 years. That's
right. And as of right now, you cannot declare bankruptcy on your student loans.
No way. You can't get out of it. I mean, there's no way. You got to pay that off. So, and I like how you say as of now, because at some point they may have to provide a loophole. They may have to provide an exit strategy for some people, because some people will literally be on the street. They won't be able to afford the payments. And so that's going to be a total disaster. So look, I'm bringing all this up not to totally bring your day down. I mean, you're probably thinking, Jerry, gosh, I was having a great weekend until you came on the radio. Geez, what's going on with you? Well, again, sometimes we need a big reminder as to why we need to save and why we need to invest and why we need to be wise with our money and why we need to do the things that we talk about on this program so regularly. And that is because we are careening off of the edge of a cliff that other empires have also careened off of. So a lot of this stuff is historically identifiable. Unfortunately, in our country, in our nation, we are really operating in uncharted territory because we're talking about trillions and trillions of dollars of debt that's just totally unpayable. You just can't pay it back. It's unreal. Did I tell you who the number one gun salesman is?
No, I don't think you told us.
Mr. Barack Obama. Mr. Barack, I'll tell you, the guy can sell guns. Since he took office in 2009, the number of Americans purchasing guns has skyrocketed, according to the FBI. Over 65.4 million background checks were performed during the last 4 years. That's roughly 45,000 background checks every single day since Mr. Obama took office. We are buying weapons. We are buying bullets. We're buying ammunition. In fact, I was looking online. One of the quickest ways to make a buck right now is to go out and buy a semi-automatic weapon, like an AR-15, and then put it on Craigslist and flip it, because people are trying to find them and buy them still, even after the Newtown shooting and even after the fears of a gun confiscation. People are still rushing out and trying to buy these weapons. And so it's very interesting. And when you compare that, the American people buying all these weapons, to the fact that government is also buying ammunition by the hundreds of millions of rounds, hollow point bullets, which are completely illegal according to the Geneva Convention because they do so much damage to your body when they enter it. These hollow point bullets are, they're deadly. I mean, you use them. They're not even allowed to be used in war, because they're banned by the Geneva Convention. The Social Security Administration's buying hollow point bullets? I mean, somebody get a clue here what's happening. Why in the world would the Social Security Administration buy millions of hollow point bullets? I mean, at some point you have to scratch your head and wonder how you got here and how you get off the bus. I mean, let me off at the next stop at some point. I mean, you've got to be kidding me. So Americans are arming, the government's arming, everybody's broke. the nation is bankrupt. Yes, we have a problem on our hands. And this show is dedicated to helping you decipher what those problems are so you can then take the necessary strategies that you need to take to protect yourself. We're running out of time. I want to bring on Tom Cloud. Before I do, I just have a couple of more things I want to tell you about. First of all, the Eurozone is officially now in recession. The Eurozone GDP dropped 0.6% in the fourth quarter of 2012. German GDP slips on exports. The French GDP is worse than expected. We take a look at Greek unemployment. It's still hitting new highs. And also Japan. Japan is still mired in a recession, and they are all guns blazing to print more money over there in Japan. So we're seeing a lot of problems in Europe. Remember, China, the number one exporting region for China is the Eurozone. And so when the Eurozone goes into a declared recession and they slow down, that has a tremendous impact upon China because China exports to the Eurozone. And the Eurozone is the largest economic bloc in the world. Now, the United States is the largest single economy, followed by China. But the Eurozone, made up of 27 countries, that's the largest economic bloc in the world by itself. And when they move into a recession, a corporate recession like they are, it certainly plays out in the economy. So we're watching that and also watching the stock market because the stock market got a little bit hit by that this week. Things kind of slowed down a little bit in stocks. Also, North Korea carried out its third most powerful nuclear test despite UN warnings, saying that an even stronger action might follow. North Korea launched their first nuclear test back in 2006. They announced another one in 2009. And now they have done their third nuclear test. South Korea, Japan, Australia, all expressing a lot of concern. China also expressing concern. But I got to tell you, you can't tell me that North Korea is not a proxy state for China. More about that later. I'm going to kind of unveil some of my thoughts about how China and North Korea may indeed be linked together in many ways, much more than we believe. One final comment here before we bring on Tom Cloud. I told you there was some updates on the petrodollar. Since 2009, China and Russia and even the UN have been pushing for a new global currency composed of a basket of currencies, including gold. Over the last several years, both of these countries, China and Russia, have been adding immense amounts of gold to their official holdings. And according to one recent report, Russia added 3.2 million ounces of gold to their reserves in 2012 alone. There's a lot of speculation occurring right now that China and Russia are planning something. Why are they stockpiling gold as much as they are? Now, we know that Russia has a lot of gold, but we don't know how much gold China has. We do know that China is the number one importer of gold in the world, and it's the number one producer of gold in the world. We just don't know how much they have because they're very non-transparent. They're very opaque with all of their information, so we don't really know how much they have. Here's the point. If these countries wanted to take down the dollar, you know how you do it? You back your own currency with gold. You build up a huge amount of gold reserves, and then all of a sudden you come out and make an announcement that could pummel the dollar. And so there is a lot of geopolitical tensions right now over the gold buying that's occurring in China and in Russia. We're keeping our eyes on that, especially how it will affect the petrodollar system. All right, with all that said, we now have our precious metals market update with Tom Cloud. Let's head over to that right now.
Follow the Money Weekly presents your precious metals market update. Here's Tom Cloud.
Well, Jerry, it's been a quiet week, and the President's State of the Union address, I really didn't get much from it, except he doesn't plan on cutting any spending, and he plans on starting 6 or 7 more programs to spend money. But on the short term, we're still in a very neutral thing. We're still between the 1640 and 1680, where we've been stuck all of 2013, and we just continue to wait on the debt ceiling issue to be the trigger that starts these markets moving, unless something happens in South Korea or Japan or China or Israel or Iran sooner. Then we're going to wait on an economic explosion to get things going. So at this point, I'm just calling gold neutral, and if it does break support, it could go down another $20 to $40 an ounce, but I think, like Richard Russell said on King World News on Wednesday, it would be a clean out that he would like to see, because he believes it would send the price even higher when the debt ceiling starts. So either way, we're in that final stage here the last probably 2 to 4 weeks of gold being stuck in a neutral range, and then we do expect it to move. Some of the people out there, I've been having calls about what I think about all this deflationary news, and certainly you and I have talked about over the last couple of days that the velocity of money is falling. The money that is coming in the system is just not turning through, so I don't see any hyperinflation on the horizon. It's going to take people thinking they need to buy something today because it's going to be more expensive tomorrow. And we're not there yet. People are still thinking things might drop. I'm not talking about metals, but just spending money out there on big ticket items. So I kind of talk to people every day and have a good gauge. I do think a lot of people are waiting to see the next direction of the metals and see if the stock market's going to hold up at that 14,000 level, or is it going to get back its gains. But one thing I do feel pretty strong about is the silver, because I'm fighting the supply channel every day, trying to fill large orders that we've had come to us in the last 2 weeks, 4 orders over 20,000 ounces each. So these are things that you don't see that often, and to see 4 of them in a short period of time it tells you what smart money is doing. I sent out that email earlier in the week that talked about Eric Sprott, certainly one of the 5 biggest names, recognized names in hard assets worldwide, talking about $200 silver, and people kind of laugh and think it couldn't go up 6 or 7 times, and yet gold's gone up 7 times the last 12 years. So what if you bought silver in 12 years for it to go up 7 times? You'd have an 18% per year. But quite frankly, Jerry, I think it's going to go up. It's going to go up 7 times a lot quicker than 12 years. But even if that it did take that long, it would still be a phenomenal investment. And the last thing to say on silver, we've seen more reports this week that are saying the same thing that we've seen for the last 4 or 5 years, is that silver is getting depleted from the Earth's crust, and there could be anywhere from 4 to 8 years of supply left, and that would be it. And certainly electronics and anything that uses silver for an industrial application is going to have to sometime go out and buy the silver when they think it's going to really start rising in price. And of course, that will help push it up. So all you silver buyers, just keep adding. If it drops down to 30 or below, you buy more. But it is the surest investment that I know out there, both from an economic standpoint and an industrial standpoint, is to keep buying the silver. Palladium is still very strong, and it's made the 30% move in 3 months. It will level out somewhere around this $800 per ounce level. We still think it's headed to 1,000, at least by the end of 2014, if not before. So keep those and then watch gold for the breakout in the next month. And if you got an entry point, just wait till you feel comfortable, and be a good time to enter. But as I've said many times on this show, I'd rather be 2 weeks early than a day late when this thing starts moving. If anybody out there wants to contact me, they can reach me at 800-247-2812. That's 800-247-2812. Or if they'd like to sign up for our email blast that's completely confidential, they could go to ftmdaily.com and hit the Precious Metals button and sign up through the FTM Daily website, and we'll put you on our distribution. We send out 2 or 3 emails a week on market conditions, specials, buy and sell signals. But once again, we do not share your email with anyone. So with this week's Precious Metals Market Update, this is Tom Cloud signing out.
Gold, silver, palladium. If you have questions about or are looking to purchase precious metals, there is one name to know and one name to call. Tom Cloud at 1-800-247-2812. You hear Tom every week on Follow the Money Weekly, and gold and silver are an excellent hedge against inflation. Tom Cloud has over 30 years experience as a precious metals advisor. Don't buy your precious metals through a call center and pay inflated prices. Call Tom Cloud, 1-800-247-2812. And for a limited time, tell Tom you heard it from Jerry Robinson on Follow the Money Weekly and receive free shipping and insurance on your order. That's right. Mention Follow the Money Weekly and your shipping and insurance charges are waived on your precious metals purchase. If you have a question about something you heard on the show, call Tom. And to secure your precious metals investment, call Tom. Your gold guy, Tom Cloud. 1-800-247-2812. That's 1-800-247-2812. You heard it on Follow the Money Weekly.
Jay Peroni, certified financial planner, here with the idea of the week. This week we'll take a look at dividends, the gift that keeps on giving. We're going to focus in on how a little-known Mexican airport could net you 10% or more over the next 12 months. What if I offered you a gift? I'll pay you $1,500 a year for the rest of your life. Would you accept my gift? Well, of course you would. Yet many investors miss out on the gifts from the stock market. You see, a $50,000 stock portfolio with an average dividend of 3% would produce $1,500 a year just in dividends alone. My all-weather portfolio strategy is designed to find stocks paying at least 3%, but I don't stop there. I also invest the portfolio in opportunities in the bond, currency, precious metals, and commodities markets to provide diversification, risk management, growth, and income. This portfolio is designed to weather the storms, to produce in both good and bad markets. When I hand select stocks for the all-weather portfolio strategy, I look for stocks that can pack a 1-2 punch. I look for stocks with a 3% dividend or higher, along with growth potential. This provides both security and profits. The all-weather portfolio strategy focuses on high quality with low volatility. To accomplish this, I look for a dividend yield of at least 3%. I want to outpace inflation with my dividends, so 3% is usually my starting point. Any dividend is nice, of course, and I'll add stocks into the portfolio with a dividend less than 3%, but that's my ideal minimum. Number 2, I look for a history of significant dividend hikes. I look for companies consistently and steadily increasing dividend payments. That provides us with a good indication that the company has a well-run business and is dedicated to delivering shareholder value. Number 3, I look for a dividend that's not dramatically higher than its competitors. If one company in the same industry pays a significantly higher dividend than its competitors, this is a warning sign. Dividend yields are calculated by dividing annual dividends per share by the stock's price per share. So this could mean that the company with the significantly higher yield has had a large decrease in its share price. Again, a very strong warning sign. Lastly, I look for a company with strong fundamentals. I look for low debt, high return on equity, lower price to earnings, strong growth prospects, and many other factors. In applying these 4 criteria, I recently added Pacific Airport Group, ticker symbol PAC, as an all-weather stock. It's currently paying a 4.5% dividend and has steadily been growing over the past 5 years. Pacific Airport Group was constituted as part of the process of opening to the private investment the Mexican airport system. Why consider Pacific Airport Group? It doesn't face any competition in its operating region. Its largest airport only accounts for roughly 1/3 of its total traffic. This limits its dependence on any single airport. It also has a highly fixed cost structure, which leads to higher returns on each passenger above a fixed cost point. Its high-margin, unregulated commercial revenue, as a proportion of its total revenue, has grown from 17% in 2004 to over 20% today. And most importantly, it turns nearly 30% of its revenue into free cash flow. Consider buying Pacific Airport Group, ticker symbol PAC, up to $65 a share. This all-weather stock is a must-have for investors looking to build a defensive portfolio. The company has delivered an annualized return of 10% over the past 5 years and could hit 75 to 80 within the next 12 months, all while paying a 4.5% dividend along the way. Again, that's Pacific Airport Group, ticker symbol PAC, worth a closer look. This is Jay Peroni signing off for the Idea of the Week. We'll see you again next week.
All right. Well, Jay Peroni is a CFP, Certified Financial Planner. a member of our Christian Financial Advisor Network, and he also manages our very own PACE investment portfolio. If you would like to have a free 30-minute review of your investments with Jay, you can call him at 888-664-6963. That's 888-664-6963. And when you do, be sure to tell him you heard about him on Follow the Money Weekly Radio.
All right, welcome back to the program, friends. You're listening to Follow the Money Weekly Radio on the web at ftmdaily.com. So glad that you're joining us every Saturday morning. We're right here. Myself and my beautiful wife, Jennifer Robinson, holds a master's degree in finance, and I tell you, she's one of the smartest ladies in finance that I know. You have a reader question or a listener question for us?
I sure do, and I'm not the smartest person in finance in this house, but... We're bringing back our listener mailbag, and we haven't had it for a few weeks. So we have a question from Mark in Texas.
We probably only have time for one question, I would imagine.
Yeah, we went a little long in the first segment, so we'll just get to Mark's question here.
Okay.
And he writes in and he says, if the feds take the path of least resistance, i.e. QE to infinity, and this method devalues and or hyperinflates the dollar, question 1, why would one want to be in the dollar or dollar-denominated investments? Question 2, would this not devastate the real estate market?
It's a real common question or set of questions. The first one being, if the dollar is going to hyperinflate, as Jerry says, later on down the road, why hold any? Well, you can't transact with gold bars. I mean, you can't walk in, to the local store and pay for, well, you wouldn't want to. You wouldn't want to pay for your bread with gold. You would want to use dollars. So there is a need to be in the currency, and we teach here at our organization the beauty of diversification, especially when it comes to your savings. You don't want to hold all your money in a dollar. You want to hold your money in a diversified manner. So we teach the DSL, which stands for Diversified 6-Month Liquid Savings Reserve. And we use 1/3 foreign currencies, which we like right now, the Norwegian kroner. We like the Australian dollar. We like the Canadian dollar. We also use precious metals. We like gold and silver as our second third. And then our final third we use with U.S. dollar denominated assets. So those are the areas that we like. Now, as far as the real estate market, yes, we are not buying real estate personally ourselves, nor do we think real estate investors are buying real estate for the capital gains. If they are, they're deceived. I don't expect housing to go up massively like we saw the last time. At least I hope not, because that'll just create another massive bubble. Remember who are buying houses right now: cash buyers, hedge funds, and corporations. You do not have first-time home buyers really entering the market the way that the market needs to experience a full recovery. We do not also have people who are trading up, like baby boomers who are wanting to get a nicer home or sell their home and get a nicer place. We're not seeing that either. We're seeing cash buyers, we're seeing investors, we're seeing hedge funds, we're seeing REITs, we're seeing corporations coming in and buying these properties, scooping them up, and also foreign investors. So the demand that we have is not the typical type of demand. And what these people are doing when they're buying properties is they're not necessarily looking for capital gains as much as they're looking for tax benefits, because there's huge tax benefits with real estate. And they're also looking for rental income. They're looking for the power.
Cash flow.
Yeah, cash flow. Exactly. They're looking for the cash flow, and not just any kind of cash flow. Cash flow that is inflation adjusted. So when inflation goes up, they can raise their rent. See, if you're working at a job and you're making $10 an hour and then inflation goes up, guess what? You can't just automatically raise your income and say, okay, I'm going to make $12 now. Your employer has to agree to that. Well, when you rent a property, you have the ability to say, oh, I'm raising my rent from $600 to $700. Why? Because inflation is going up. So they're buying it for that inflation-protected cash flow that they want to create. That's why we like real estate. Inflation-protected cash flow, not for the capital gains. The house may go down in value. I don't care. I just want the inflation-protected cash flow.
And of course, as always, beware of adjustable rate mortgages.
Absolutely. Well, if you have a question you'd like to ask to us, you can always send that to us. You can go to our website and click the Ask Jerry button and fill out the form, or you can just shoot an email to us. That's info@ftmdaily.com. We be sure to put your name and town on all correspondence so we can properly answer your question. You can also call our Q line, 800-609-5530. Just press option 3, and you can record your question there. And if we choose to use it on the program, we will, and we'll answer it on the program. I want to let you know also, all of our FTM insiders, I am working right now on a little article about this Pope situation. What else do you call it? I mean, the idea that has been bantered about quite a bit, this prophecy by St. Malachi. The ideal here is that this final Pope may be upon us according to this prophecy. And I think that's pretty interesting, no matter what beliefs are. Nevertheless, it's intriguing. So I'm writing a article about the resignation of Pope Benedict. I'll be putting it in our FTM Insider area in the next couple of days. So if that's something that strikes your fancy or you find interesting, be sure to check that out. We're going to head over now to John Burrs with our Retirement Minute. John did a fantastic job at our last Building True Wealth conference back in Des Moines last weekend, which was a very well attended, and we had a great response. I want to give a big shout out to all of our friends, new friends out in Des Moines, Iowa. And John again did a fantastic job. Here he is with this week's Retirement Minute.
All right, where's my money? Money. Daily bread.
Follow the Money Weekly presents the Retirement Minute.
With all the end-of-year hype surrounding the fiscal cliff and the relief that came with New Year's legislation permanently extending most income tax rates, one change seems to have caught most people by surprise: the 2% increase in FICA tax. That increase, the result of an expiring provision that was not extended, means that the vast majority of American workers are now receiving about 2% less in their take-home pay. Remember, in the midst of the last recession, a little more than 2 years ago, Congress passed and the President signed the Tax Relief Unemployment Insurance Reauthorization and Job Creation Act of 2010. This new law included a 2% reduction in the Social Security portion of the FICA tax. The provision was designed to help put a little more money into the wallets of American workers during the challenging economic environment of 2011. While the employer portion of the OASDI contribution remained at 6.2%, the employee contribution was reduced from 6.2% to 4.2%. The provision was extended through 2012 by the Temporary Payroll Tax Cut Continuation Act of 2011 and the Middle Class Tax Relief and Job Creation Act of 2012. The reduction was never meant to be permanent, as it put additional financial pressure on the already stressed Social Security Trust Fund. So during the 2012 fiscal cliff negotiations, both Democrats and Republicans agreed that it should expire at the end of the year. Despite media reports warning of the impending payroll tax increase, many Americans were caught off guard when they received their first paychecks in 2013. How much of an impact might the additional withholding have? Well, a family earning $60,000 a year will see their pay cut by about $1,200 a year or $100 a month during 2013. Those earning about $100,000 will receive about $2,000 a year or about $167 per month less. While most experts believe the decrease in take-home pay won't be enough to cause major economic damage, it may encourage families to cut back on spending enough to slightly dampen the nation's overall growth. For example, the 2% decrease could represent a family's monthly utility bill, an investment in a college savings account, or a week's worth of groceries. If you have questions about your FICA withholding, your Human Resources Department or personal manager might be a good place to start. These representatives are typically prepared to answer such questions and, more importantly, can confirm that your withholding is correct. So make sure your financial affairs are in order, and a good way to start this process would be to contact me through the Christian Financial Advisors Network by email at John, that's JOHN, at CFAnetwork.org. Or you can call me toll-free at 888-914-9909. I would be more than happy to review your financial situation with you to make sure your financial house is in order. And thank you for joining me this week for your Retirement Minute.
All right, friends. Well, that brings us to the end of our program. Thank you so much for choosing to allow me into your life each and every week. It's an honor and a privilege to be a part of yours as well. And as always, I leave you with this final word, this time spoken by the great J.R.R. Tolkien, when he said, "If more of us valued food and cheer and song above hoarded gold, it would be a merrier world." Just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and I'll see you right back here next weekend. God bless.
The views and opinions expressed by the guests on Follow the Money Weekly do not necessarily represent the views of FTMDaily.com or Makers Group Financial, LLC. Even though these are proven strategies, Jerry Robinson is not a financial advisor, and his guests are not legal or tax advisors. You should always consult a trained financial advisor and or tax advisor before making any financial decisions. John Burrs is a registered representative of and does offer securities through Sycor Securities Incorporated. Lifetime Decisions Management Incorporated is not a subsidiary of nor controlled by Sycor Securities Incorporated.